Is NASDAQ a buying opportunity? We'll try to figure it out today. Defensive sectors are leading while the offensive sectors are lagging. Interest rates have collapsed as I predicted, and as investors are seeking safety of Treasury bonds. We'll do a trade example for Intel, and this is a little bit different. We'll see how to avoid large losses. And we'll finish up with gold, which could be ready for records as dollar drops like a rock. All this and more in today's edition of MasterChartsTrading.com market recap for Friday, August 2nd, 2024. As always, hit the like button, subscribe to the channel, share this video, ask any questions you like relevant to the discussion. If you're a subscriber, stay tuned. You can see this was extremely busy week. There's a lot of securities we're going to be covering, namely market breadth, Bitcoin, Ethereum, crude oil, natural gas, and some of the currencies like Euro versus US dollar, USDJPY currency pairs are going to be covered in members only video. Lots of ETFs, large cap stocks, as well as various speculative securities that we're going to be covering in the members only video. If you're not yet a subscriber, consider signing up by going to the link in the description. Throughout the presentation, I'll be using my proprietary MasterChartsTrading.com trading indicators, which you can see on this chart, this green, blue, red, and yellow lines. These are basically support resistance lines, but I also use them as a trend trading for trend trading purposes. All right, let's look at S&P 500. We're currently looking at the index S&P 500 on July 16th here, or let me see. Yeah, July 16th we made a new record, and basically the past 2 weeks we've been dropping. We can also look at the weekly chart. Weekly just means each candlestick is a week's worth of activities. People freak out when they see this candlesticks. Don't freak out, it's really easy. If you really need help, I can provide it. But just looking at this chart, you can see that we had 3 weeks of in the red, and we're now at the green support resistance line. We had something similar right here in March. We had 3 weeks in the red. We were at the green support resistance line. We turned around and we continued higher. Will we have something of similar nature? No way to tell. However, we definitely are somewhat overextended, and a deeper pullback is quite likely. In fact, let's look first at NASDAQ. Here is NASDAQ futures, and notice that back in March this pullback sort of stopped at the green support resistance line, and then we see a new move higher. For NASDAQ right this instant, notice this pullback is quite significantly deeper than for S&P 500. In fact, we're down to this blue support resistance line currently. Notice that the difference for S&P 500, we're only down to the green support resistance line. So first support has been broken, which is a green lines, green support resistance line. It has been broken for both S&P and NASDAQ. NASDAQ is exhibiting more weakness. Notice this pullback towards the blue support resistance line. Now, normally we buy there. Normally, when we see a touch of this blue support resistance line, we go ahead and we buy there. Question is, are we going to be correct this time? Now, as I just said, we're seeing a somewhat different picture than the one that we saw in March. And this time, we could see further weakness by other sectors, and I'll get to that in a second. But for now, we're looking again at S&P 500 on daily time frame. Notice this break where I'm hovering right there. So notice this green support resistance line. It was acting as support since 24th of July here, and then today on Friday we gapped. So we gapped below this green support resistance line and continued lower. So this is not a good sign. This is a support break, pretty clear support break. And usually this type of support breaks, they don't just end. We usually see some sort of a follow through to the downside. Having said that, again, clearly we're still in an uptrend. There is no even a remote indication that we are now in a bear market. So bear market, by my definition, implies the following. So stock needs to close below this yellow support resistance line, which is currently away from today's price action by almost 19%. It's a very long way down. Can it happen? Sure. If a nuclear war breaks out tomorrow, most likely the stock markets will close. If a major war breaks out, even more major than the one we have right now in Ukraine, and possibly one that we're about to see in Israel, maybe even more major, something of that nature breaks out, then we could see serious downside pressure. But for now, I think we should be concentrating more on further pullback towards this blue support resistance line, at which point, when or if we get there, it would become a good buying opportunity. We want to be buying around that area because we're still in an uptrend. And for example, let me show you what was happening before. There is the previous opportunity to buy back in November of last year. I personally bought there, S&P 500 ETF SPY. There it is. I'm still open. I sold half my position back in January of this year because I thought that was it. No, we continued higher. So for now, my stop is at the blue support resistance line, which is exactly where we want to be thinking about buying. But I want to preserve my profit. So for now, I'm just holding, and we're going to see where this goes. I'm also holding QQQ in the NASDAQ, and actually I am getting ready to exit at least this trade, which I opened back in January of the last year, 2023. So I've been holding it for a year and a half now. Right this instant, we will see basically where we go from here. Again, notice that the NASDAQ is very close to the blue support resistance line. So if we're going to see support manifest itself, then this would be a very good place for it to do so. Now, we've been hearing a lot of stories about artificial intelligence really not panning out to be a big deal yet. I mean, there are some incremental progress. There is ChatGPT, which you could use to create your dating profile. You can do all kinds of funny things like write your resume. But, artificial intelligence is still in its infancy. And a lot of companies that are, currently reporting, for example, NVIDIA, Intel, which will get in a second, they're all trying to get into this artificial intelligence ecosphere, but there is still quite a bit of issues with that. So are we going to see something similar to what we had to the dot-com boom and bust? Maybe. Maybe this time is going to be different, but those are the famous last words. This time is different. So I don't really like to, worried too much about interpreting social trends and technology trends. I would rather concentrate on interpreting the chart. And in this case, the chart is telling me that we're getting close to the point where we should be interested in buying of NASDAQ. We're not yet close to where I would be interested in buying S&P 500. S&P 500 needs to drop around 5% more for me to become interested. By extension, the NASDAQ would continue probably down as well. So this blue support resistance line could be like just the first line in the sand, and we will again monitor this. And if you're a subscriber, again, you will be the first one to be notified if there is anything of interest. For example, are we going to buy in NASDAQ or not in the near term? A few stock sectors rather, have exhibited what I call a flight to safety response. So we have two generally broad groups of stock sectors. We have consumer staples, we have utilities, and real estate. So these three, ticker symbols XLP, XLU, and IYR, that are more could be thought about as a defensive sector. So this type of stocks are, people always need this stuff. Like utilities, everybody needs electricity. Real estate, everybody needs a place to live. Consumer staples, yeah, everybody pretty much needs a toothpaste. And then there are offensive sectors, like, for example, technology or consumer discretionary. So discretionary would be things like restaurants. Technology, obviously, is things like Google or Apple. So right this instant, what we're seeing is a leading by the consumer staples, utilities, and real estate, and lagging by those offensive sectors such as consumer discretionary and technology. So this type of behavior, investor behavior, is thought of as flight to safety sort of thing. Now, if a real, honest-to-goodness bear market will start, you cannot hide in utilities, you cannot hide in staples or real estate. Everything gets sold. So I can show you, for example, during the 2008 financial crisis, this is consumer staples, and they also collapsed. Okay, so you will not be able to buy toothpaste and hope that your stocks will not go down. Yes, everything will collapse, but for now we're seeing a sort of flight to safety response. So we're seeing consumer staples moving higher, we're seeing utilities moving higher, we're seeing real estate moving higher. Now, real estate also is dependent on interest rates, which I will get to in a second, which have indeed collapsed, as I have predicted. So what we're again seeing is, if the current situation continues, perhaps we're seeing those first bearish indications, where we have leadership from defensive sectors and lagging from offensive sectors. Will it actually translate into a bear market? We will only find out when or if we get there. But for now, yes, there is a somewhat flight to safety for utilities, for consumer staples, and for real estate, where investors pile up in those sectors in hopes that they will provide sort of relative safety. And again, relative safety versus absolute safety. There's only one way to do that, and that's not do anything with stocks at all. So here is, for example, consumer discretionary, and notice that we can look if this was all-time highs or not. We were not yet at all-time highs for consumer discretionary, but nevertheless we're definitely in an uptrend. Notice this blue arrow here back in April, so this was actually a successful trade. Before that, we see several opportunities, one back in October of 23 and another one in November of 23. Currently, we're there. We're at the blue support resistance line, following a larger gap. So definitely oversold within a bigger uptrend. Okay, we are consumer discretionary sector is in an uptrend, and we are oversold. So this is a recipe for bounce higher. We don't yet have a signal. So a signal occurs when we dip below the blue support resistance line and then close above it. We have dipped below the blue support resistance line, but we haven't yet closed above it. We could continue lower, and this means that we just need to wait and see what happens. For now, I'm just going to stay out of XLU utilities and see what happens. Technology sector is the same general, idea. Notice that we have, I believe these are all-time highs. Yeah, these are all-time highs. Technology sector hit all-time highs in July and pulled back. Now we're oversold. Yes, within a bigger uptrend. Yes, but not yet a trigger. We don't yet have a trigger to buy. A trigger to buy would occur when we see a low below blue and a close above it. So, for example, latest opportunity was in 2023. Okay. So, to put it again in total perspective, we're seeing offensive sectors such as technology and consumer discretionary are lagging, but defensive sectors are leading the stock market, or are leading, relatively leading higher. So this is a state of current stock market. We will continue to monitor it. Let's switch gears just a little bit. We're currently looking at 10-year Treasury note yield. Okay, and we're in a daily time frame here. So the numbers on the right here, they actually show the yield, interest rate. And so notice back here in April of this year, when the interest note yield came up to this green support resistance line in April of 2024 this year, and it was rejected there. So this is what I wrote back there: rejection of higher rates. So we went as high as 4.7. I'm reading it off the chart, about 4.7, and then the investor said no more. And then we pulled back and noticed that we broke below this blue support resistance line, and this was around 4.4, and this is a 10-year Treasury note yield. And again, we kind of broke below it and a little bit, bounced around and then continued lower. Again, another break occurred right there on the 11th of July, where I'm hovering, and this was around 4.2%. This is an outright bearish indication for me when interest rates close below this red support resistance line. I'll show you in a second the opposite of this, or the bonds themselves, because Treasury notes and Treasury note yield move in the opposite direction. So Treasury bonds and Treasury yield move in the opposite direction. So right here on July 11th of this year, we saw a break below 4.2% or so, and at that point I wrote rates below 4% in September. Indeed, we got this. We got it actually yesterday we broke below 4% where I'm hovering. Today we collapsed. We're currently at 3.7% for a 10-year Treasury note yield. So rejoice, your credit card interest rate will go down. Your mortgage rates are going to now continue lower. Pretty much everything that you need to borrow money for will be less expensive. Car loans, etc. So this is happening without any Federal Reserve interference. It's just happening because the market participants have decided that the interest rates were too high. They started buying bonds. So let's look at bonds, and there they are. So it's 7 to 10 Treasury bonds, and this is an ETF, ticker symbol IEF. So notice what happened here. We saw a move higher. I mean, this was an actual alert here on 3rd of June, and nice, huge, big move, especially today. Gap up and run higher. So I actually own myself this ETF. This is a 7 to 10 Treasury note bonds. I also own the Treasury 30-year Treasury bonds, TLT. But just looking at this chart, notice that it's basically an inverse of what I just showed you. So here is the interest note yield collapsing, and there are the bonds rallying higher. So bonds and yields move in the opposite directions. For now, again, we are, we're long bonds at MasterChartsTrading.com. We're long Treasury notes, Treasury bonds, ETFs, meaning that we bought them. We are considering them to continue going higher. I mean, of course, there might be a pullback. There will be a back and forth, but the general direction is up for bonds. By extension, the general direction for interest rates is down. So if sometime in the near term, and there's talk about Federal Reserve lowering interest rates further, this would further benefit Treasury bonds, and we should be benefiting from this as well. So this is what we're seeing right now. We're seeing, taking it all together, basically we're seeing a flight to safety response. So bonds are rallying, interest rates by extension are dropping. We're seeing defensive sectors rallying. We're seeing offensive sectors dropping. So this is a classic flight to safety response by the investors. What are we flying to safety for? What are we running away from? That's a very good question. Perhaps some sort of a big event is coming, and we are going to witness it soon. It's also possible that no big event is coming, and we're just simply looking at market forces right now. Interest rates were just too high, and they're coming down. So eventually things will settle down. But from a point of view of risk, right now there is risk off time period. So the investors probably don't want to take too many risks at this point, and it actually kind of makes sense because September, for example, is a relatively weak month. It's a relatively weak month for stocks. We are right now in August, but we're not that far off from September. So perhaps August would be just sort of flat. Maybe it would trade slightly down to flat, but perhaps September would be an even more difficult time period for stock investors. So we will see where this goes. And I wanted to highlight a way how to avoid losing money in the stock market. So losses are inevitable. The way we make money is we're making more money on our wins than we lose money on our losses. However, you will have losing trades. Anywhere from 50 to about 10 to 50% of trades could be losers, and yet you will still make money in the overall strategy. So here's one such example where cutting losses is of utmost importance. So here's Intel. This is an actual alert, and I believe I bought it myself back in October of last year. It was a nice move higher. I did not send any alerts out here back in March. I should have probably, but I just didn't like this action. And I was correct not to like this action, because notice that we gapped down between 2nd of April and 3rd of April, continued lower towards the red support resistance line, broke below that, and then collapsed more towards the yellow. So notice that I sent this to my subscribers saying caution back in April of this year, and then avoid in May of this year. So avoid just means that we need to get out of any open positions, if you had any open positions. I had no open positions, and hopefully my subscribers did not either. But let's pretend for a second that you did have an open position and you just decided to wait for it to go up. Now, notice that today we had a earnings report, and earnings report for Intel was horrendous. They missed their mark by 80%. So they made no money, they lost money. It was a disaster, basically. Clearly, investors said, we don't want any of that, and everybody sold at the same time. So there was not a single trade between $29 and about $21, so it gapped. It's a gap down, and then finally it sort of stabilized around $21 today. That's a 30% drop from where I sent alert out to avoid it. So if you got out back in May, your loss would have been significantly less than if you got out today. So again, if you're a trader, then you will know what I'm referring to here. You need to basically cut your losses. And if you don't cut your losses, then you might end up with bigger losses. And this is a clear example of that happening. So hopefully you got out and back in April, May, and you moved on with your life, and hopefully you did not hold it through this pretty disastrous earnings report. Very briefly, let's look at dollar and gold relationships. So today we saw a very large drop for the dollar index. This is DXY, dollar currency index. Huge move down. Very interesting that, notice it stopped exactly at this red support resistance line. I am not, these lines are not being drawn by hand. This is a mathematical calculation. And clearly the robots and the humans who trade, they look at the same levels. So we're right now basically at a make or break point. If we break below this level, which is currently at 103.1 for the dollar, then dollar we'll start thinking about dollar as being in a downtrend. Up till now, we're still thinking it was in an uptrend, but at this point, it's almost a guarantee that this level will not hold. So this has an implication for commodities, especially precious metals. And here is one of those, XAU divided by US dollar. So XAU is gold divided by US dollar. So like I just showed you, this US dollar component, the bottom part of this equation, just got smaller. So gold by extension moved higher. This is a normal reaction, normal relationship between gold and dollar. We're very close to all-time highs for gold. Dollar is weakening further. Gold is taking advantage of that. So we're approaching fresh records. Most likely, if dollar, weakens more and continues lower, then gold will continue higher. So for whatever reason, gold is moving higher. Perhaps it's inflation, perhaps it's flight to safety. Once again, flight to safety, as I was just showing you. What are we seeing in the future? Could there be big events that we're not yet seeing in real life? Things of, destructive potential for humans? Unfortunately, yes. And this year, 2024, could be a decisive factor in the Ukraine-Russian war, because, I'm following some of the Russian-speaking analysts, and it's pretty scary what's happening there right now, as far as Russia basically throwing everything they have at Ukraine and not really making a lot of progress, but yet they continue to do that. So the losses are staggering. And could we see a use of not conventional weapons, chemical weapons, biological weapons, hopefully not nuclear weapons? I think it's a possibility. And could that be the trigger for another crisis? Definitely, yes. So perhaps we're already seeing that in the reactions of the investors, or there's something else completely entirely. I really hope that I'm wrong. I really don't want to see, weapons of mass destruction used in Europe. It's a very small space. So that's what we have so far. Let me know what you guys think. Make a comment. Are we moving towards a bigger conflict, perhaps in Ukraine, perhaps in Israel? And are we seeing this flight to safety, as I just described? Various defensive sectors are outperforming versus offensive sectors underperforming, and Treasury bond yield is collapsing. So all of those taken together definitely paint a picture of something not very good happening. Other than that, thank you again for watching all the way to the end. Head over to MasterChartsTrading.com, click on sign up one of the products. Again, I have trading indicators, newsletters, and a combination of both trading indicators and newsletters. So the trading indicators, you can have this green, blue, red, and yellow lines on your chart. This is a TradingView.com interface. TradingView.com is free. Once you sign up on TradingView.com, head over to my site, sign up on my site. I will open the door for you on TradingView.com. Newsletters, I send out daily alerts about various securities we trade. So notice we have quite a bit of securities to cover. Bitcoin, Ethereum, crude oil, natural gas, some of the currencies, ETFs, large cap stocks, and speculative stocks are all covered in the members only section. And of course, the best deal is to get both trading indicators and newsletters, and the best deal is to get the yearly, of course. Now, there's also the monthly subscription, so you can get that as well. Again, thank you for watching, and have another great trading week. Bye-bye.